So hello, welcome everyone, and thank you very much for joining this webinar where we will cover off our latest syndicate opportunity, the Market Recovery Collection. To start us off with a bit of housekeeping, Callum, as I'm sure you've been able to notice, is unfortunately unable to make it today, so I'm afraid you will be subjected to a far less eloquent introductory section than you are perhaps used to. That being said, I'm Ollie. I'm Operations Director here at WineFi. I'm joined by our Head of Investment, Matthew Small, and our Head of Data and Analytics, Aaron Amerly-Daniel. This presentation will run through the micro and macro conditions that we are currently seeing affect the fine wine market, the thesis behind the Market Recovery Collection, and an overview of the market-leading data methodology that goes into all of our portfolios. To provide a very brief introduction as to what we do at WineFi, our mission is to make investing in fine wine as easy and accessible as investing in an index fund. Our syndicate model allows investors to gain diversified exposure to expertly curated portfolios of fine wine at a fraction of the cost of owning the underlying assets outright. Finally, the chat on the right hand of your screen is open, and we actively encourage you to ask any questions you may have throughout the presentation. We will take a quick break after Matt's section to answer any questions that we've received up to that point, and we should have a time for a Q&A at the end to answer anything that we haven't already covered throughout the presentation. Without further ado, I will pass you over to Matt.
Thank you, Ollie. And hello, everyone. Thank you for joining us today. I'm going to go through a little bit about fine wine as an asset class. Then we'll also discuss what we're seeing in the market right now and dive into a little bit of the fundamentals, and then have an overview of our current collection and how it's different from our others and how it's geared to take advantage of the next bull market. So first off, characteristics of fine wine as investment. Why do people invest in fine wine? Well, first off, it's a good source of long-term growth, right? It has a very unique interplay between demand and supply. One of the key characteristics of fine wine is its ability to age. So as it ages, it creates secondary, tertiary flavors. Basically, it tastes better and demand goes up. And then on the supply side, well, each vintage is fixed. There's only so many bottles made each vintage. And then as the wines age, supply decreases due to loss, damage, and consumption. And this is the unique part about fine wine. Whenever that wine's at its optimum drinking window, it's also at its scarcest. And it's that dual interplay between demand and supply, which increases price over time. Nextly, fine wine has what we call a low rolling correlation coefficient with traditional asset classes like equity and fixed income. And therefore, it means it's a great diversifier and excellent complement to most people's traditional portfolios. Also, due to its liquidity profile, when we see times of market stress like the equity markets, fine wine prices are not as impacted. So it's a good diversifier to complement people's existing portfolios. And then lastly, it's CGT exempt in the UK. So in most cases for UK investors, fine wine is what's called a wasting asset under the HMRC classification. And that's an asset with a useful life of under 50 years. So all the wines we pick at WineFi for our portfolios and our syndicates adhere to this classification. And we provide all our investors with a letter of recommendation from our tax consultant to confirm this. Okay. So next, let's have a look what's happened to fine wine over time, and then dive into what we're kind of seeing now. So here we can see the LiveX 1000, which is the industry broad-based benchmark, and how it's performed since inception in the early 2000s. And you can see, like most asset classes, fine wine experiences market cycles. And what I'd really like to kind of dive into is the most recent market cycle, which happened basically early 2020, which was related to COVID. And we saw a real boom in the market. And this boom was driven by an increase in alcohol consumption. People were stuck at home, drank more for a form of entertainment. There's an increase in disposable income. So people weren't spending on what they usually did, like holidays and going out for restaurants. They spent more on luxury goods. And also more macro focused, there was an increase in the money supply. Central banks started printing money for furlough payments. This increased the money supply, which then increases fixed assets like fine wine. And we saw the values of fine wine increase dramatically over a 14-month period. So if we look at regions, for example, the Burgundy 150 increased 50% over a 14-month period, and the Champagne index increased 60% over the same time frame, which is a far quicker pace of growth than what we've traditionally seen. But this then corrected, mainly due to the dovish monetary policy, which caused inflation in the market. This then forced central banks to increase interest rates to curb the inflation. And what we've seen with fine wine is it doesn't like high interest rates. What that causes is an opportunity cost, or a higher opportunity cost, to look at other asset classes which bear a yield, but also it increases or decreases the propensity to consume. And this then caused a 34-month correction in the fine wine market. But where are we now? Well, since August last year, the supply and demand dynamics have changed slightly. We see the LiveX 1000 increase quarter on quarter since then. And we'll be diving into this a bit more in the next few slides. But one thing I would like to highlight in this slide is the red dotted line. So this is the long run trend for the LiveX 1000. And where we currently are is nearly 2 standard deviations below that. So it's trading at a significant discount. This is the largest discount we have seen in the fine wine market since 2006. And one of the main compelling reasons why we think now is an opportune time to get involved in the fine wine market. So let's look at the fundamentals behind the shift in the market. So I mentioned a minute ago, the correction lasted 34 months. And one of the large reasons for this is we had to work through a large amount of liquidity on the supply side. So up to basically August 2022 to early 2013, fine wine markets by and large have been increasing in price. Merchants were sitting on more stock in their balance sheets than they historically would have. And that's because it was an asset. It was increasing in value. But as soon as that changed and prices started to fall, merchants started liquidating stock, and we got a lump of supply on the market. And we were working through that over a 34-month period. And that's really what we're looking at in this bar chart. So each of these bars represent the change in list prices quarter on quarter. So list price increasing, indicated by green shading, staying the same, indicated by the purple shading, and decreasing, indicated by the red shading. And really, if we look quarter on quarter, we can see the number of list prices increasing has increased. And why that's important is that's a good indication that the amount of stock that the market was trying to work through was happening, and the supply side was getting closer to an equilibrium. Because if we still have a load of stock to work through, you're going to have an increase in the red bar quarter on quarter. But we've seen the opposite. We've seen an increase quarter on quarter, leading us to believe we're reaching a more supply side equilibrium. So next, let's look at the bid side or demand side. So here we're looking at the bid offer ratio. So bid offer ratio, total value of bids divided by total value of offers for each of the constituents of the LiveX fine wine indices. And we can see with nearly every indice, year on year, quarter on quarter, month on month, there's been an increase in this bid offer ratio. So what does that tell us? Well, more demand coming to the market, and more demand being attracted by current market pricing, but also the confidence to rejoin the market to saying this is a great opportunity. So we've seen a bit of supply side equilibrium. We've seen an increase in demand, but what's happening then to actual market prices? So here we see the WineFi trade price index, and this is an index which focuses on the most liquid wines in our investment universe. And why we focus on the most liquid wines is because they're the wines that tend to react quickest to a change in market conditions. And as I mentioned, these are based on trade prices, so exchange prices and auction prices. So these are where the wines are transacting. And we can see for the last 2 quarters, so basically since August 2025, we've seen an increase in trade prices in the most liquid wines. But it's not just our indices that are showing that. If we look at the top chart here, we're looking at the two broad-based industry benchmarks, the LiveX 100 and the 1000. And we can see since August 2025, a similar pattern indicated by the green shaded area. We're seeing an increase in prices up until February this year. And if we also then look at the auction market, so we look at the Wine Market Journal 150 index, which looks at the most liquid wines on the auction market. It's actually been increasing in value a quarter earlier since Q2 2025. So we can see the market fundamentals are transferring, or the improvement in the market fundamentals are transferring into the real world in trade prices, in the LiveX indices, and in the auction market. And that brings us on to our current collection, the Market Recovery Collection. Well, how do we capitalize on current market conditions? Well, we'll be focusing on the most liquid names, similar to what I said in the previous slide. It's the most liquid names that respond fastest to the market change in market conditions and will increase in price the fastest. But we're also looking at wines which have had a considerable drawdown, the wines that represent really good value in the current market conditions. And then we apply our proprietary model, which looks at the probability of the wines increasing over the next 5 years. And combining market timing principles with our own proprietary model to maximize returns, we believe this is the most effective way to take advantage of the current market conditions. And I'd like to draw your eyes to this table here. And if you just go to the bottom line. So we're looking at the returns of the LiveX 1000 since inception. And we can see the average CAGR is 5.8%. Now we've looked at, if we go a line up, what would happen if we invested at the start? We got the market timing perfect. How would that improve returns? Well, we can see that then increases the CAGR to 7.3%. Then if we apply our WineFi investment methodology and our quantitative models, we then are able to increase our expected return to 12%. And that's based on our historic backtesting, which Aaron will go into in a bit more detail. So it's that combination of market timing and our quantitative model that we're trying to really leverage here with this collection. And if we then dive into a little bit more about the portfolio construction, well, from a regional weighting perspective, we're doing our typical regional weightings based on our white paper, which I can share after this. So we're going for a global exposure, but with overweight regional weightings to Burgundy and Champagne, Tuscany. And these are the regions with the highest risk-adjusted return. From a risk profile standpoint, this, I would say, is our lowest risk syndicate to date, based on the regional diversification, but also the wines, like I mentioned earlier, will be the most liquid blue chip wines to take advantage of the market change in market cycle. Expected 5-year hold period, similar to our previous syndicates. And as we saw in the previous slide, our expected returns are 12%. And lastly, I'd like to touch on current macro conditions. So this is a chart from our Q4 report where we looked at different macro variables that impacted the fine wine market. And what I'd really like to focus on are the purple lines, or purple bars, which is the impact post 2011. And the macro factors that impact the market the most were monetary supply. So M3 money supply, increase in the M3 money supply, as we discussed earlier, increases fine wine prices. UK interest rates, a decrease in interest rates also increases fine wine prices. And lastly, and also linked to these two, the value of sterling relative to other currencies. So decrease in the value of sterling increases demand for fine wine in the UK, increases prices. And then this just brings me on to the kind of recent geopolitical tensions we've seen in Iran. So the markets are now pricing in for this year an increase in the base rate of 1%, which is a contrast to what we saw before this Iran conflict. We were expecting a 50 basis point decrease. So how will this affect the fine wine markets? Well, as we know, an increase in interest rates is a headwind for fine wine. However, it won't impact it immediately. It will be a very gradual increase if we're in the same condition in a year's time. However, if this turns out to be a Trump skirmish where he goes in hard and then backs out and negotiates a deal, like the taco trades we've seen, we don't really expect that much of an impact in fine wine. As I said, fine wine prices move quite slowly. If this is resolved in 6 months, we don't see any imperial impact. And as we've seen, Bank of England, if anything, want to decrease interest rates to encourage economic growth as opposed to raise them. So before I hand over to the head of data, Aaron, is there any questions at all? Guys, please, if you have any questions, fire them in the chat. We'd love to answer them.
Brilliant. Well, Aaron, do you want to crack on, and we can hopefully receive some questions and cover them in the Q&A at the end?
Yes, of course. So as Matt rightly said, I'm going to talk about the data side. I'm Aaron. I'm the head of data and analytics here at WineFi. I head up our data team and data function. And the absolute majority of my time is spent making sure we build the data systems and have the data we need to buy the right wines at the right prices for our clients. And Matt is the one that talks about wine in general terms and all of the market forces acting on wine. And I'm the one that says that it doesn't matter. We're going to make outsized returns regardless, or at least that's our aim. And I'm going to talk about a little bit about how we're going to do this. So why is data-led asset selection important in fine wine? Well, the biggest point I want to get across in this section is that not all wines are created equal. Not all investment grade wines present the same opportunities. And even amongst the kinds of wine labels that are in the LiveX indices, the most highly traded blue chip wines, there can be significant mispricing within vintages. There can be times where a given vintage has a large amount of supply on the market, and for that reason prices decrease below where they should be, or perhaps below an intrinsic value. And then in the subsequent period, they can give outsized returns. So my job is to build the kinds of models that identify those mispricings so we can take advantage of them for our clients. So this plot is kind of to demonstrate that. So we have 10-year average returns of a basket of a subset of 10,000, more or less 10,000 liquid investment grade wines. These are wines with current active listings, and they are all above £100 a bottle. And you can see the bottom 50% of returners averaged about 3% or just under 3% annualized returns. And the top is above 11%. So there's a significant spread there. And being able to analyze opportunities at scale and identify which are going to be in that top 50% or even in the top 10% is our job here in the data department. So I'm going to talk a little bit about how we try to do that. So there's lots of steps to our data process. Obviously, having the right data is a massive part to it. Then we use, once we've collected all this data that we maintain, we build what we call our WineFi investment score. If you follow us on LinkedIn, you will have heard us shout about this, but basically it's a metric we build that ranks wines based on their potential to outperform the market over an investment period, the coming investment period. So we basically do a ton of experimentation and testing on theories and the kinds of ideas that people use to select fine wines. And we're looking for approaches, strategies to investing that have proven across time and across market conditions to give outsized returns. We're identifying and finding variables that are predictive of future outperformance in fine wine. So the kind of raw data that goes into this is, of course, critic scores and transaction prices and bids and offers, comparative pricing metrics. And we basically build a library of these variables, these features that are predictive of performance, and include them in a machine learning model, which optimizes weightings based on back testing and historic pricing data in order to select and rank assets today for returns. Once we built that model, we then back test it. And the back testing is essentially simulating real world conditions. We're buying a portfolio worth, say, 100 or 200,000 pounds worth of wine with this regional split and these liquidity criteria. So in this case, we'd be having our highest minimum liquidity criteria. And then we look at the performance of those portfolios on back tests. This is an example of one of these back tests. And to explain the process going on here, I'll spend a little bit of time explaining it because it's important. It's important to understand. So we basically will pretend it's a point in the past. In this case, it's 2012. We'll hide all future data from our modeling. And then we train the regression models that I just spoke about on predictive variables that we've identified. And then we optimize the weightings based on historical trends. And then we use this trained algorithm to make the WS rankings for all investment grade wines. The WS score, which is a score from 0 to 100, is then filtered out. So we take only, in this example, WS scores of 70 or greater. So we're only isolating the wines that our model says these are most likely to outperform. And then we buy them, we simulate buying them in a portfolio scenario. And in this plot, you're basically seeing each of those simulations for this given investment year. So each single thin gray line is a portfolio. The purple line is the WineFi mean portfolio, the WineFi WS portfolio. So that could be thought of as the typical performance in that investment period. And then we've also plotted the LiveX 1000, which is the benchmark for that period. So obviously you can see an outperformance here, and that's what we want to see. And then we will do this for every investment period from 2009 onwards. And then we use those aggregated statistics as the basis of our expected historic returns. And that is pretty much it from me on the data side. I think we can probably open it to questions.
So we have a question from Andrew. What happens if the LiveX 1000 doesn't keep going up, and doesn't this nullify your collection thesis? Which is a really good question. Aaron, I will point that one in your direction, I think.
Yeah, this is a good question. So this is actually why I chose the to show the 2012 this year in the plot. So I intentionally chose a period where the LiveX 1000 didn't necessarily shoot up in like a typical consistent recovery. In this period, it went down a little bit and then was stagnant for a few years. And the reason I chose that is that I wanted to show that, well, firstly, the LiveX 1000 is a basket of the most liquid, highly traded wines. And it's representative, obviously, of market health, of course, but it's not exactly a measure of certainly the performance of our portfolios, but also just fine wine as a whole. It's a great health check, but it is biased towards the most liquid fine wines and the youngest blue chip fine wines. And our strategy, both in terms of buying the right wines and buying wines at the right prices, can outperform significantly, even if the LiveX in this case has been returned zero over, say, the first 4.5 years of the whole period. Any other questions?
We can give it kind of 30 seconds potentially, and then if no further questions, we can wrap it up.
We like questions because it gives us more LinkedIn content.
Yeah, that's true. Oh, we've got one from George here. What do you see as the main catalysts for growth in terms of pricing? Matt, sounds like one for you.
So I think George is getting at the different variables we look at when it comes to picking wines we believe are going to outperform. So our model, as Aaron said, there's 38 different variables we use. Some are very self-explanatory, like average critic score or vintage. Then we go into almost relative value metrics, where we go price per point. We look at, we take kind of a value consensus and create what we call a wine yield curve. Sorry for getting a bit geeky here, guys, but we're going into this. So basically we're looking at, okay, how consistently does this wine outperform as it ages? And then other things we look at is more market specific things like beta. So how sensitive is that wine relative to the region and the fine wine market as a whole? And each of these metrics we have identified individually has predictability on future price. Then when you put the machine learning element to it as well, it finds relationships between these variables that then further enhance your returns.
Yeah, and another element we look at is proxies for attention. You know, are these producers brands, which we tend to think of as being equivalent? Are they being talked about more or less? And is that relative? How is that relative to other brands / producers and relative to their own history?
And from Andrew again here, how do we know we own the wines in our names? Matt, I think that's one for you.
Good question. So each of our investors get a letter of attestation from Coterie Vaults, where we store the wines with the contact details for the team at Coterie Vaults. We can also set up visits to Coterie Vaults if you wish. It's a really cool place, super high tech, really interesting place to visit and to see the wines in person. And then you can also do your own due diligence by contacting Coterie Vaults yourself to confirm the wines are there. We also store all the wines in our investors' names.
I can attest to Coterie Vaults being a really cool place to go and visit. It's a real shrine to fine wine, and the just rows upon rows of amazing wines is a really cool thing to see. We've got one from Henry here. How do you expect changing drinking habits to impact future returns?
That's an interesting one, Henry, because we're hearing a lot about GLP-1s, people drinking less. However, the data we've seen when it comes to alcohol consumption, that Gen Zs, for example, which is meant to be this cohort that's drinking less, is actually spending a higher percentage of their income on alcohol. Now, I also think an important part to this answer as well is you have to divide fine wine into its segments, right? Or sorry, wine into its segments. Now, if I was CEO of a lower priced wine company at £5 a bottle, I might be a bit concerned. But we definitely are seeing premiumization and more people interested in fine wine. And that can be attested to the number of people who are outside the trade doing WSET qualifications, the amount of really good information that's now available on the internet. And globally, the interest in fine wine as the top premium category, we believe is increasing.
Yeah, and I think anecdotally as well, you see a lot of people taking or talking about fine wine as being the only real wine. You know, there's a massive movement against mass production and unknown huge corporate entities making, you know, wine, and people are becoming more and more interested in you know, the craft beer type movements where they want to know where something has come from and has a story behind it and feels more human and less faceless. Yeah,
100%. I think there's a really interesting analogy that was made on wine versus fine wine and likening it to, although not exactly the same as, cigarettes and cigars, and the kind of push to kind of stamp out smoking in public places, etc., lowered the use of cigarettes, but had no effect on the kind of premium end of that category in cigars. So I think that there's an interesting analogy to be drawn there, although they're quite different characteristics to the markets. Oh, we've got a question from George. Where do you see the most asymmetric opportunities in fine wine today, given we're likely near the bottom of the cycle?
So I feel like we don't want to give too much away here, but I would be looking at very, very good historic brand power with large drawdowns and a relatively high beta. So I mean, one name I'd look at is what Lafitte Rothschilds have traded down the most, just to give away something. But that's kind of our main selection process.
Yeah, and I think more generally, the most asymmetric opportunities are with the wines that are harder to price. And the better you are at valuation, the better you are at spotting those asymmetries. If a wine's trading every single day, multiple times a day across all exchanges, there can't be that much opportunity in terms of being better at understanding the true inherent value of the wine.
Yeah, that's a really good point. From Marcus, there are a lot of major factors that past data modeling uses to assume that the market will return. Cheap money attracting investment demand, huge growth in Chinese demand for wine, which has now disappeared. Does the prediction models assume the return of Chinese demand or cheap money coming back?
No, they're agnostic to market conditions. There's no assumptions of that kind in the modeling.
And I think an important point to add to that is China has been largely absent for the market for the last 10 years, and that's in the price. So if there was an ever uptake in Chinese activity, the risk is to the upside as opposed to the downside.
Yeah, 100%. I mean, it kind of ties back, Aaron, to what you were saying about outperformance regardless of market conditions. Like what our models are great at doing is picking wines that will outperform. And it's not tied to an assumption of Chinese demand coming back or macro assumptions in general.
Yeah, and the reality is fine wine, I mean, I can't overstate how important it is buying the wines at the right prices. And obviously this is something we work very hard on, but it's a very disconnected and somewhat opaque market, fine wine. And the rarer the wine is, the harder it is to understand the true value of the wine. And so, identifying these opportunities, they occur at all points in the market cycle. And right now we happen to be at a stabilization point where we can combine this kind of mispricing signals and this kind of strategy with positive micro forces in the wine markets.
Fantastic. Well, if we don't have any more questions coming in, which we may do as I'm wrapping up. Here we are. From George, can a model meaningfully capture factors like provenance, critic influence, and brand prestige, or are these inherently unquantifiable? This is a very interesting question. I think you can split that into the factors. So I can assume that you both want to answer. The floor is yours.
So if I could just jump in first. So obviously I'll leave provenance to Matthew and Ollie, but that is something that they do on the sourcing front. In terms of critic influence and brand prestige, obviously one of my favorite phrases that a mentor told me is models are never right, but some are useful. And what my job is to make sure that the model that we're using is useful, and everything we do is a proxy for inherent brand power, for inherent reputation, for even inherent true latent price of a wine. All we can do is proxy and build variables that correlate or work towards our what's the word, pragmatic. They function. When we simulate historically, if we had used this strategy, how would we have performed? Do they work? That's the true test. And if they do work, then we can assume that we have captured some percent of this true, difficult to quantify, I should say, factors.
And then on the provenance piece, everything we buy is what LiveX would call SIB, so original case, OWC. We're buying them from the right countries or labels. We're buying them in pack sizes that are most liquid on the secondary market. And then we check everything. So there's a great authentication team at Coterie Vaults that do spot checks on the wines we buy for not just provenance, but authentication, and to make sure we got what we paid for. So provenance is key to everything we do here.
100%. I'm getting the feeling that trying to wrap up brings more questions. So if I start again, then we might get another one. But thank you very much, everyone, genuinely, for joining. And thank you for all of the really insightful questions. I mean, I think the team will agree that anything that gives us the chance to nerd out about the wine markets is a good thing. And we hope that it's been useful for you guys. As a reminder, the Market Recovery Collection is now live and open to investment. You can find links to view the full investment thesis and to invest on our platform, on our website, and in all of the emails that we send out to you. If you have any questions or queries following this webinar, then you can reach out to us on support@winefi.co or directly to any of us if you've already got our details. And yeah, like I say, we'd be more than happy to go into detail on anything covered in today's webinar. Brilliant. Well, thanks very much, guys.
Cheers, guys. Thanks for joining us.